This is Al Brooks. Thank you for watching the Brooks Trading course. This is the third of 3 videos on trading major trend reversal bottoms. I keep making the point that there are no perfect setups. Traders look at bottoms, at tops, and they just don't seem good enough. However, if they meet certain criteria, they are good enough, even though they're never going to be perfect. Whenever you're not sure whether or not to take a signal, it's perfectly reasonable to wait for a second signal, like a micro double bottom or a micro double top. Bull trends need higher lows. As long as the market continues to make higher lows, it's still in a bull trend. However, if it falls below one of the higher lows, it's then either in a trading range or in a bear trend. This is the euro versus the dollar. It's a daily chart. Every trade that you take, buying or selling, is always a trade-off between probability and risk reward. One side of the trade, the buyer or the seller, gets relatively high probability, and the other one gets relatively high risk reward. You cannot get both. A perfect trade cannot exist. If there was a high probability of making a very big profit with very little risk, everyone would take it. There would be no one left to take the other side of the trade, and the trade would not work. For example, buying a lower low or a higher low major trend reversal is not a high probability trade, but the risk is small. If you buy above that bear bar, above this bull bar right here, your stop is down here, you're risking very little, you have huge profit potential, so you have an excellent risk reward ratio, but your probability is only about 40%. For most major reversals, the probability of making a swing profit is 40%. 60% of the time, you'll either make a little bit or lose a little bit. A major trend reversal is usually a low-risk trade, but the probability is also low. As I said, there's about a 40% chance of making a big profit, a reward that is at least twice your risk, and there's a 60% chance of a small win or a small loss. As long as you're making a reward that is twice your risk, the math is good enough to take the trade. However, when you're taking a major trend reversal, do not be too quick to take your profits. If the risk is very small, 2 times your risk is here. While mathematically it's okay to take your profit here, you have the potential to break above this lower high and test that lower high. So it's usually better to hold on to at least part of your trade until you're certain that the trend reversal has failed. Some traders do not like to take low probability trades. They like to win most of the time. Those traders tend to enter later after there's a strong breakout. At that point, the market is clearly strongly bullish and the probability of making money is greater, 60% or higher. However, there's less profit remaining in the trade, and if you enter late in a breakout, the stop is further away, so your risk is greater. Taking the low risk, low probability trade or taking the high probability breakout trade where the risk reward ratio is not as good are both good approaches to trading. We have a breakout, we have a follow through. You can buy the close of the breakout bar, the follow through bar, the next follow through bar. We have a surprise breakout here. The market is stalling and then suddenly it accelerates. High probability that the market's going at least a little higher, but there's less reward remaining because you're entering late in the trend after the market has already rallied. Again, the euro versus the dollar. We have a bear trend, we have a bull break above the trend line, and now we have a triangle. Triangles late in a bear trend often become the final flag, which means you get a breakout and a reversal. Here we have a pair of big bear bars. Usually you're going to get at least a small second leg down. This is a small second leg down, even though it did not go to a new low. Some traders will not buy that first reversal up because they're afraid of the market having a second leg down, and the second leg down might be big. Buying the first reversal up is lower probability. It's slightly higher probability to wait until after the attempt at the small second leg down reverses up, and now you have a second entry buy for the failed breakout below the triangle, a trading range, and the breakout below yesterday's low. In addition, we have a strong bear breakout, disappointed bears by the follow-through, and you can see what happened here. The market tested that low close and reversed up. What does that tell you? It tells you that the bears who sold this close hoping for a big bear trend were disappointed by these three bars, and they decided to buy back their shorts around break even. That created a micro double bottom, and that makes this a higher probability buy. If you want even higher probability, you wait for a strong breakout and strong follow through, and then you buy the close. A 5-minute chart of the euro versus the dollar, a very strong bear trend. We have a bear trend. The market went sideways for about 30 bars, breaking out of the bear channel. That's pretty good buying pressure. This is potentially the final bear flag, and therefore if there is a bear breakout, traders will look for a reversal up because potentially this could be the start of a bull trend. Therefore, we have a lower low major trend reversal here, but after 3 big bear bars, you expect at least a small second leg down. And we have it, and now we have a bull inside bar closing on its high. This is a reasonable second entry buy for a lower low major trend reversal. The rally, it's okay initially, but then it's starting to stall. What do the bulls do? Well, after a wedge top, here we have 4 reversals down, 1, 2, 3, 4, and a lower high. This is a double top bear flag in a bear trend. A lot of the bulls will get out below that low and conclude that instead of reversing into a bull trend, it's reversing into a trading range. So their premise has changed and they'll get out. Good looking setup, but the result was only a small profit. What happens over here? Now it's another attempt at a reversal, this time a wedge, 3 pushes down, 1, pull back 2, pull back 3. But the channel is very tight and it lasted a lot of bars, 10, 15 bars. Usually the first reversal up out of a very tight channel is minor, which means it becomes either a bear flag or a trading range. Therefore, this is not a very good buy setup, even though you can argue it's a wedge and another attempt at a major trend reversal. Had you taken this buy and you did not get out here, you would have gotten out on your stop just below that low. For a small loss, you would have bought here, you would have exited here with a small loss. Most major trend reversal trades, buys or sells, result in either small losses or small wins. Had you gotten out here, you would have had a small win. 40% of them lead to big wins. The market's in a very tight channel. The pullbacks are only lasting a bar or two. Therefore, the bears are strong. On a higher time frame chart, all of these little pauses would be invisible. This would simply be a series of big bear bars. Same with this. This would be a series of bear bars. This is a 5-minute chart. If you looked at a 15-minute chart, you would not see these little hesitation bars. You would just see a series of bear bars, and the same with here. A very strong bear trend on the next higher time frame chart. When that's the case, it's usually not worth looking for reversals. It's better to only be looking to trade in the direction of the trend. Any reversal is probably going to be minor and just last 1, 2, or 3 bars and become a bear flag and lead to lower prices. All bear trends are constantly trying to reverse here, 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 here. And those reversals are minor, leading to bear flags and a continuation of the bear trend. It's better to only look to sell when the market is in a tight bear channel. Again, a 5-minute chart of the euro versus the dollar. Strong bear trend. The bulls were able to stop the bear trend for about 10 or 15 bars, and now even longer, 20 or 30 bars, and they have a reversal up here. This is a lower low major trend reversal. bear trend, bull breakout of the bear channel by going sideways, and then a failed bear breakout and a reversal up. Here is a reversal up from a higher low, and this is even better for the bulls. A double bottom, higher low, major trend reversal is a slightly higher probability trade. And the bulls have a very good bull bar closing on its high. Bulls would either buy on the reversal up above this bear bar, betting on the double bottom, higher low, major trend reversal, or some traders prefer only to buy above a strong bull bar, so they would buy here. If they buy above any of these bars, their initial risk is to below the bottom of the double bottom. They put their stop there, and the size of this blue box is their initial risk. This is 1 times their risk. This is 2 times their risk. Anytime you're taking any trade and you exit part or all at 2 times your risk, the math is good. It's a profitable strategy, and if you do it 100 times, you have a very high probability of making money. The actual risk here, had you bought on a stop above this bull bar, the actual risk was only a couple of pips. You could always exit at 2 times your actual risk, and that might be 4 pips. However, that's too small, especially when the leg down was 60 or 70 pips. Also, the minimum scalp size that you should take anytime in the Forex market is 10 pips. If your actual risk is only 2 pips, 2 times your actual risk is 4 pips. That is less than the smallest scalp you should ever consider, and therefore you should never take 4 pips profit. When the actual risk is small like that, the next thing traders should look at is the initial risk, which is the distance from their entry price to their stop, and then consider taking partial or full profits at 2 times the initial risk. And here, that is more than a 10 pips profit, so it is acceptable. Also, after a strong reversal up, you expect at least a couple legs up, 1 pullback, 2. If you did not take profits here, you're probably disappointed by this follow through, and now that we're getting a second entry short with a bear bar closing on its low, this would be a good location to take your remaining profits. Your premise of a strong bull trend is probably not very strong anymore. You've had your 2 legs up, and the second leg up was weak, and it's about a 50% pullback in a bear trend. This is probably a bear flag that will lead to a test of the prior low. If you want, you can call it a wedge bear flag. 1 push, pullback, 2 push, pullback, 3 push. Also, you're in a strong bear trend, and there's a gap between this low and the moving average. In fact, all of these bars are gap bars. When you have gap bars, it's a sign the bulls are strong. They're strong enough to put bars completely above the average price. However, the first gap bars that you get in a strong bear trend usually result in a test back down to the bear trend low. However, they also usually lead to the final leg of the bear trend before the bulls get a major trend reversal attempt, which they had here. So is this a major reversal? Well, it turns out it was minor. The bear trend resumed. However, a strong minor reversal late in a bear trend usually leads to a major reversal the next time the market tests near the bottom of the bear trend. And that's what happened here. Very often you'll get major trend reversals early in a session, and they don't look like they're big enough. They don't have enough bars. Also, they tend to involve climaxes, and you get very sharp reversals, and the market does not look strong enough to reverse. For example, this is the start of the US session, 5:30, 6 o'clock California time. And for the bulls, they see a bear trend, a bull breakout lasting about 30 bars with a bunch of gap bars. They expect the next sell-off to at least bounce a little bit. Bears see this strength by the bulls, and they're afraid the bear trend is turning into a trading range, and therefore they'll buy back their shorts near the bottom of the developing range. And bulls will buy, taking a chance that instead of a trading range, we'll get a bull trend. So for them, this is a double bottom major trend reversal. They could buy the first reversal up. This is strong enough up so that there probably will be at least a small second leg down. And that's what took place here. A lot of traders would prefer to buy a second reversal up above a bull bar, which would be right here. Either way, the initial risk is small. Whether you buy here or here, you're going to put your stop below the bottom. And what happens up here? Well, we got one leg up, pull back, two legs up, a little bit of a parabolic wedge, one, pull back, two, pause, and then three, and possibly a big expanding triangle top. High, higher, higher, low, lower. A lot of the bulls would exit on a second reversal down, thinking that this is the top of a trading range instead of the start of a bull trend. So it's reasonable to exit here. Yes, it's a major trend reversal buy, you could hold, but once you start to get 3 or 4 consecutive bear bars, if you did not already exit, it's probably worth exiting with a small profit. An example of a major trend reversal where the market rallied fairly strongly, but you still ended up with a fairly modest profit. Different ways to draw the expanding triangle. 1, 2, 3, or 1, 2, 3. In any case, it's a triangle. A triangle is a trading range, and you're getting a second reversal down, and the rally started losing momentum, and the follow-through was bad here. That makes it more likely a bull leg and a trading range than the start of a bull trend. Trading range, buy low, sell high. The bulls sell high to take profits. The bears sell high, betting for a test down to the bottom of the range, or possibly a double top bear flag, break below the neckline, and fall for a measured move down. I mentioned the importance of second signals. Whenever you're not sure that a trade is strong enough, it makes sense to wait for a second attempt. 5-minute chart of the euro versus the dollar. Strong breakout above a bear channel, 2 legs up, and a gap bar, and another gap bar usually leads to a major trend reversal attempt. I like to sell these gap bars, especially when the trend is that strong, thinking that, yes, it'll probably lead to a major trend reversal attempt, but it will also lead to a leg down testing the prior low. Strong enough reversal, a sell climax and a very strong reversal, it's reasonable to take a chance that the market will reverse, and therefore you can buy above this bull bar for a lower low major trend reversal. However, there are 7 bars in this final bear leg where no bar went above the high of the prior bar. It's a 7-bar bear microchannel, and some of the bars are very big. The bulls buying this are hoping for this being a climactic end of the bear trend and for the market to reverse up sharply. And it began that way, but it did not continue that way. When you have a very tight bear channel, a bear microchannel with strong bear bars, the probability of the market turning into a bull trend is small. More likely it's going to end up as a trading range or a bear flag. Here we have a double top bear flag, but it's a reasonable buy, 40% chance of a very strong reversal. A lot of traders do not like to take the first reversal up when the final leg down is this strong. They'll wait for a second reversal buy, like a micro double bottom or a double bottom. Had you taken this and you did not get out below this reversal down, you'd get stopped out here with a relatively small loss, maybe 20, 25 pips. Anytime a stop is hit, there's a 50% chance that you're going to get a trend and 50% chance that the market will soon try to reverse again. Whenever the bear trend resumption has 20 or more bars, especially if it's in a tight channel, I like to start the process over again, looking for a major trend reversal, which means I need a break above the bear channel, and then a test back down to either a higher low or a lower low. Would I call this a lower low major trend reversal? No, too many bars down. The bear trend, I think, has resumed. Also, the channel down is very tight. While this could be a low, and you can argue a wedge, 1, 2, 3, it's probably going to be a minor reversal, and the bulls will need some kind of strong reversal up from that minor reversal before traders will believe that the bulls have a chance of a major reversal. And that's what happened here. This is probably going to be a minor reversal, and then the bulls have a higher low and another higher low. This is a higher low major trend reversal. And if you want, you can call this a higher low major trend reversal as well. You start the process over again. New bear trend. You need a break above the bear channel, the bear trend line, and you need it to be reasonably strong. Here we have gap bars, so the bulls were strong enough to put bars completely above the moving average. We have a lot of bull bars starting here, closing on their highs. That's good buying pressure. We have consecutive bull bars here and here and here, so the bulls are getting strong. We have a first entry buy here, not enough bars for a major reversal. Maybe enough bars here, but a bear bar and a tight bear channel. A lot of bulls will prefer to wait for a second entry buy, either above this bar for a small double bottom or above this bar for a micro double bottom. That would be a higher probability buy here or here, looking for a higher low major trend reversal. A lot of trading range price action, big reversal up, big reversal down, strong reversal up, a bear breakout, and then a relentless reversal up. Most major trend reversals evolve into big trading ranges. Whether or not they have a swing up, they usually become big trading ranges. If you're in a trading range, you expect deep pullbacks. For example, we're in a bear trend and you got a deep pullback here after all of this trading range price action. Here we have a rally and a relatively deep pullback, and here we have a rally lasting about 40 bars and a strong bull breakout and a strong sell-off. But it's either a deep pullback in a trading range or a deep pullback in a broad bull channel. We have a higher low, we have a higher high, so the market's in a bull channel at this point. Bull channels often have strong reversals down that are strong enough to make the market always in short, but they fail to get below the most recent major higher low, and therefore the bulls will buy that strong sell-off, betting that it'll form another higher low, and the bull trend will continue up. Is your stop below this buy climax? Well, a buy climax is a magnet. You could put a stop there, and if you get stopped out, you buy again on the reversal up. To me, the second leg up, here's the first leg up. The second leg up began here, so this is a major higher low. And if I'm swing trading this and I see a lot of trading range price action, I want my stop below the most recent major higher low. I'm not opposed to getting out here. You got a failed breakout above a trading range. You have two legs up, one pullback, two, a lot of trading range price action. But if you do get out, you should be looking for a reason to buy again if the market reverses up from a higher low. This is not a strong buy. Maybe here, a second entry buy, maybe here, and certainly buying closes here are all good. If you are buying, let's say you bought that close, your stop really needs to be down here. You have to buy very small. When traders take that buy, a lot of times they take a normal size trade. They think, oh, it's okay. I got my stop down here. But in their heart, they don't believe the market can get anywhere near that stop. But when you see this much trading range price action, lots of reversals, lots of tails, lots of tight trading ranges, you have to use the wide stop, because when you have trading range price action, you tend to get very deep pullbacks. For the bears, they see this whole thing as a deep pullback in a broad bear channel. And for the bulls, they see this as a deep pullback in a broad bull channel. You can swing trade and rely on your stop, but if you do, you have to trade small. We have a double top bear flag attempt. First entry, second entry failed, and we got a strong bull breakout. But 50% of breakouts above double tops fail, and that makes them a type of wedge. 3 reversals down, 1, 2, 3. So this is a type of wedge, and it's a lower high and a bear trend. It's reasonable to get out of your longs. Whenever I see a strong breakout like this, and I look to the left and I see a lot of trading range trading, and I see a bear bar closing on its low, I usually always get out because there's too much risk of the breakout failing and for a swing down. Also, it's a second leg trap. First leg up, pull back. Second leg up, very, very strong second leg up. Yet we have that bear reversal. That has a higher probability of being a second leg trap when you know you're either in a trading range or a broad bear channel. The opposite is true here. A strong sell-off, but you're still possibly in a broad bull channel. Traders will look to buy the reversal up. At this point, the market is sideways for about 50 bars, and it's also sideways for about 100 bars. The bears see a broad bear channel. The bulls see a broad bull channel. They are both correct. Whenever there's a lot of trading range price action like this, there's always a good reason to buy and a good reason to sell. Swing traders trade it like a swing. They rely on the wide stops and don't worry about the reversals, the frequent reversals. Some traders repeatedly exit and re-enter. A bull would exit here and then buy the higher low. A bear would sell here and then exit down here. Both are acceptable. Since we're talking about this in terms of the bull case, a higher low major trend reversal, and now we're getting another higher low, bulls would look to be buying again. It's around a 50% pullback of the entire rally. Extreme buy climax at the end of the American session, reasonable to take profits. Micro double top. We went up, we went down, we went up again, and we're going down again. Probably not a lot left to the day, and the market probably will enter a very tight range for the remainder of the day. If you're swing trading, you have to allow pullbacks. And if you're swing trading in what you think is a very broad channel, you have to rely on a stop below a major higher low, not a minor higher low. Again, very strong breakout, terrible follow through, looks like a reversal, a failed breakout, and it's reasonable to exit below that bear bar. Some bulls will hold on to their longs, even if they bought this high close, and then scale in lower, relying on their stops. If you bought here, you're probably not going to be scaling in when it goes above here. You'll probably hold on to your original position. But had you bought here and used this stop, you probably would scale in, buy more on the reversal up. Again, buying a higher low major trend reversal. And the market is mostly sideways here. It's still in a broad bear channel. The bears will sell this as a double top bear flag. Bear trend, we have a double top bear flag here, slightly lower second high. And here we have a double top bear flag here or here, slightly higher second high. And we have a second entry sell with a pretty good looking bear bar closing near its low. It's a reasonable sell, betting that either we're in a bear trend or in a trading range. Remember, whenever there's a lot of trading range price action, traders will look to buy low, sell high, and a lot of traders will keep scalping. Trading range in a bear trend. The bears want trend resumption down. They see a double top bear flag. And the bulls want trend reversal up. They see a higher low major trend reversal. That's always the case in a trading range. There's always a good reason to take a swing long, and there's always a good reason to take a swing short. And it's okay to do either one, as long as you go for a reward that is at least twice your actual risk. That's always your minimum target. And you have to use an appropriate stop. If you're a bear, this is the most recent major lower high, and therefore, if it gets above this high or this high, your premise of a bear trend is probably wrong. It's then probably either a bull trend or a trading range. And for the bulls, they're viewing this as the start of a bull trend. We have a higher high and we have a higher low. If it falls below this low, if they take this buy and it falls below this low, their premise of a bull trend is wrong and they have to get out. In this particular case, the bulls won. And you can see what happened when the market went above the stops for the bears. It accelerated upward. The bears gave up. They concluded that it's no longer a bear trend once it went above one or both of these major lower highs. And they gave up here. The bears are giving up. And the bulls knew the bears would give up, and the bulls bought aggressively. I made the point a moment ago about bull trends needing higher lows. 5-minute chart, euro versus the dollar. Bulls buy, hoping for a higher low major trend reversal, maybe 40% chance of a swing up. Stop below the bottom of the bull trend. Remember, if your stop gets hit, your premise of a bull trend is no longer valid. The market has either evolved into a trading range or the bear trend has resumed. In either case, you do not want to be holding long for a swing up. So you get out and you take your loss. After every new strong bull breakout, trail stops to below the most recent major higher low. Strong bull breakout, this leg up began here. Some traders would put their stop here at the bottom of the buy climax, but that's such a magnet. If I'm going to exit here, I would rather just get out below that bear bar, because once it gets below that bear bar, it's probably going at least a little bit below here. So putting a stop here, to me, is a skunk stop in the middle of two reasonable stops. The reasonable stops are either the very tight stop exiting below the bear bar or the wider stop below the major higher low. If you did choose this stop or that stop, and we're getting a higher low here, and you're willing to take the swing trade, taking a chance that we're in the early stages of a broad bull channel, then you buy on the reversal up. We have a small bull breakout of a tight bear channel. We have a higher low, a micro double bottom or a small wedge here, 1, 2, 3. And we have a pullback here from this bull breakout, reasonable to buy on the reversal back up there for another higher low. We have another reasonably strong breakout here, going above that high. Two good choices for the stop. This is the major higher low. This is a minor higher low. But a lot of traders will look at this and say, okay, we got 4 consecutive bull bars. We're breaking above this high. It's okay to put a stop here, because if the bull trend is really strong, which is what I hope it is, it should not come back to even below the bottom of this little breakout, never mind the bottom of the new leg up. You can call this a wedge bottom if you like, and a second entry buy. Some bulls will take that buy. Not much buying pressure. Very tight bear channel. More likely a minor reversal. Once you get the minor reversal, if it's reasonably strong, then traders will start looking for a major reversal. At this point, this is probably a minor reversal buy looking for a scalp. The market tested down. It tried to reverse back down again, but found buyers again at the original buy price. So this is a test of the breakout above that buy signal bar. It's a breakout test. The bears tried to go down, reversed up, tried to go down, reversed up, tried to go down, reversed up, repeatedly failing to break back below that entry price and below this low, good buying pressure. The bears are failing. It's a reasonable buy for a possible higher low major trend reversal. Once the market tests the original entry price and resumes up again, the bulls are not going to let the market get down to that entry price again. They know if it does, then their premise of a bull trend is wrong. And if it's wrong, they'll get out. And therefore, if the market tries to get down to that entry price again, they'll buy, even if it's a strong sell-off. This strong sell-off, especially below that bear bar after the breakout, will trap a lot of the weak bulls out. A lot of the strong bulls will get out as well and look to buy the reversal up. And it also traps weak bears into selling. A lot of the bears who sell here will simply scalp looking for a deep pullback. And if you swing trade and you understand what's going on, that the market's trying to get below the entry price a second time, and it keeps failing with these small bars and then a reversal up, strong bears will get out. They'll see that the market is unable to break back below the entry price a second time. First time had many little attempts, and now a second time. That increases the chances that this is the wrong way. 5-minute chart, euro versus the dollar. Bear trend, pretty good buying pressure here. More bear trend, even stronger buying pressure here. We have about 7 or 8 bull bars, and then some more bull bars, moving average gap bars. Strong sell-off, terrible follow-through. Bears tried to sell off again, they cannot. And now we're reversing up a second time. First buy above this bull bar, and second buy above this bull bar. This is a good second entry buy for a higher low major trend reversal. Possible parabolic wedge, we went up, we went down. We went up again, down, and up a third time down, up a fourth time down, but probably not going to lead to a major reversal. Probably at best the bears get a minor reversal. Here they got 1 bar. For the bears at this point, they're hoping that it's another lower high in a bear channel. Lower high, and then they're hoping that this is another lower high. But a very tight bull channel, maybe a 10-bar bull micro channel, only 1 bear bar. The sell signal bar has a small bear body and a big tail below. Chances are there are buyers below. Can you take partial profits here? Well, it's around twice your initial risk, and that's always okay. And this might be turning into a trading range, and that's another reason to take partial profits there as well. Whenever a trader is looking for a major reversal, at a minimum, he's looking for 2 legs up, 1 pullback 2, and usually 20 or more bars. If you're buying a higher low major trend reversal, you've already had 1 leg up, and therefore you may only get 1 more leg up. And most major reversals evolve into big trading ranges. You have a bear trend and then a bull trend. Big down, big up usually results in big confusion and a trading range. And therefore, traders tend to take profits around prior highs, like this high or that high. We have a micro double top here. We went up and went down. We went up again and we're going down again with a bear bar. So a micro double top, failed breakout above that major lower high. Reasonable to take partial profits there. Very tight bull channel, unlikely to be a major reversal into a bear trend. More likely the best the bears get is a trading range. It's reasonable to take profits there, or you can wait until we get some kind of a double top up there and then take profits. Here we're at the end of the session. Bars are starting to get very small and sideways. This would be another location to take profits for any reason up here, especially on any reversal down. I began by talking about how perfect trades cannot exist. You cannot have a high probability of a big reward with very little risk. And therefore, don't worry about trying to find a perfect trade. Just worry about trying to find a reasonable trade. If ever you're taking a trade and you think the setup is not quite strong enough, wait to see if you get a second signal. That would have higher probability of success. And a bull trend is a series of higher highs and higher lows. If the market falls below a major higher low, it's no longer in a bull trend. It's either in a trading range or in a bear trend. And therefore, you cannot be holding long if your premise is that you're in a bull trend, because it's no longer a bull trend. You put your stops below the most recent major higher low. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 3 videos on trading major trend reversal bottoms.